All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Market getting ready to wrap up here for the week, and it's down, about 50, 60 points here, 50 points here today, which is, seems very light and is very small movement relative to what we have seen. And it is the first inside day for the market that we have seen since the coronavirus sell-off has started, where the market trades within the range of the prior day, and that's it. And it's the first time we have seen it where it's traded in between the open and close. We've seen it trade within the range once, but the first time where the open close, all the price action is within the prior day's open and close. And a lot gets made out by technicians when it comes to inside days in terms of candle patterns and everything else. When you really kind of break it all down and you start to explore those that have done the calculations and the numbers, it's pretty insignificant as far as what's it mean. It doesn't have a strong bullish bias, doesn't have a strong bearish bias, and one of those where if we see 2, 3, 4 inside days in a row and then it breaks, yeah, that has a big bias. But just one day doesn't necessarily mean anything when it comes down to it. So we've had one of the bigger rallies here in the history of the market. And yes, it's not the biggest in the history of the market, but this week's rally has been one of the biggest in the history of the market, which is, normal to talk about when we go through very abnormal situations, like what we have seen, where we have some record selling, we've had some record buying, in terms of the movement. What's driving it? Is it fund managers coming back in? Is it stock pickers coming back in? Well, it's not stock pickers. It's not stock pickers. In fact, we can see with the lack of differentiation in stocks that is certainly not stock picking that is driving things. This morning, JP Morgan came out, talked about two things driving the market. A short squeeze this week, which, yes, in fact, you look at some of the short data from last week, people were piling in on the short side last week, and just got absolutely blitzed this week in a huge way, and that drives some buying and some of the aggressive buying that we see. And then another thing they mentioned, which I found really interesting, was they talked about this allocation between stock and bonds within some of the biggest funds around the world. And I know when I say other funds, most people think, oh, well, fund managers, they're getting in, they're buying this, they're buying that. But a lot of the biggest funds in the world, they're not doing any sort of stock differentiation. What they're doing is saying, okay, what sector exposure or what stock versus bond versus currency exposure. And some of the biggest funds in the world are just, hey, we're going to have this much exposure to stocks and this much exposure to bonds. Well, one of the things that's happened over the last month is that the stock and the bond markets around the world have changed in terms of their relative values in a big way. So their stock bond ratios have changed outside of what the fund parameters, kind of say, hey, they should be. And so JP Morgan argued this morning that a lot of the buying we have seen here is just from some of these big funds that have taken and rotated money out of bonds and into stocks, and just to get their allocation correct here. And it's something that, yeah, we've seen before, and yes, it happens. Can we measure how much of it is shorts versus how much is fund allocation? You can't really measure it, right? So it's one of those where you could talk about it and it being a reason why and everything else, but, to what extent? And okay, is it going to continue and all of that? Those aren't real helpful in terms of understanding what's going to happen here going forward. But I do think if you look at this market and you go, okay, this market's driven up this week by a short squeeze, that gives you no information as far as which way the market's going to go next. Doesn't give you anything. Because the bottoms of markets typically start as short squeezes. They're not the longs jumping back in. They're the shorts jumping out. That's where bottoms kind of start to come in. And, it's one of those where we can see that happen multiple times. So it doesn't really say anything. The whole bond stock allocation thing, what does that mean as far as this week's action? For me, not a thing. Absolutely nothing. It's something where we know it happens in the market, and yes, could it continue? Sure, could. But normally, when it happens, it's a quick adjustment that they make, and then they don't make any more adjustments for a few more months. They're not in adjusting every day, every week, every month. Some of these funds will adjust, 2, 3, 4 times a year, not 2, 3, 4 times a day, to alter things with the market. So, they don't really tell me a whole lot. They don't really help me a whole lot. Now, over the last several weeks, we've talked about the factors that are going to be indicative of what's really going on out there, and we've talked about several charts. One of them being this chart here, the number of cases around the world when it comes to the coronavirus, and this chart down here as far as growing exponentially. And as long as it continues to grow exponentially, it's something that there's significant downside risk still in the market there for it. Now, the market will likely bottom before this chart tops. I realize that. That's, what we tend to see. But, it is still rising in a very exponential fashion. And, it's one where you pull up China and you look at it, and, yeah, it's just flatline. No new cases there. The world doesn't quite trust that. Italy, still growing exponentially. But South Korea, it's slowing in its growth. So there is some hope that this curve is going to change. But so far, we have not seen that happen. So chart number one, not giving anything where I go, okay, you know what? Bottoms in. We'll get back to normal in a month and a half, 2.5 months. Everything will be, rosy. There for things like a lot of people want to say, and a lot of people want to argue out there. The next chart that we've talked about are financials. Without a bottom in financials, the market is not going to bottom. Now, we have seen financials snap back in a massive way here this week. But in terms of a full retracement, the way other stocks have, they have not done that. In fact, the financials here are still a ways away from a full retracement of the drop that has happened. So they have not snapped back the way some other stocks have. They have been lagging in all of this a little bit still, which doesn't make me feel too comfortable. Okay. The other charts we've talked about need to change are the volatility charts. What do we mean? Well, the VIX, right? When we see markets turn, the VIX tends to bleed heavily lower. We're not seeing that. The VIX did go down this week. But some of the biggest updates we had this week saw the VIX going up. You say, well, the VIX isn't going up much today. The market's down 40, 50, 60 points. And you're right, it's not, because a 40, 60 point move is pretty light compared to other days. But we are not seeing any real contraction in the VIX. We're just seeing more stabilization here overall. When we look at the VXX, which I think is valuable because of it using futures contracts, we're not seeing anything to a huge degree, but that Monday, Tuesday action certainly drew this down in a pretty sizable way here. So we're starting to see possibilities of this turning, but not the action where we go, oh, okay, it's breaking into that the new lows that we need to see the VIX itself start to break into. And by new lows, I'm talking start breaking down below 55. Start breaking down below these early March levels, and we will see fund managers start to come back. Right now, you're a fund manager out there, and you're going, okay, I want to get in. I want to go buy Bank of America. I want to buy this stock. It's really cheap right here, but I know the market's going crazy right now. Some things could happen. I need to buy protection. What's it cost to buy protection? the cost of protection is huge. So if you're going to buy, you kind of have to be buying a little bit naked. And that's not a comfortable position for investors. And it's one of the reasons why we tend to see when bottoms happen, there's a significant move to the upside because the investors are starting to get in later when protection becomes cheaper. And right now, protection is still sky high. Now, the other thing in terms of volatility we need to see is not just that cost of protection, but the average true range. We need to start to see the average true range on the market fall. Now, this week did something. It didn't see an increase in the average true range for the first time, but it sure didn't see much of a decrease in the average true range. Today is creating a little bit of a decrease, but we can't look at this and go, oh, well, the average true range is really starting to fall off here. Market safe, off it goes. But those are some of the things that we need to see, for this to be a turn that is not really susceptible to a massive sell-off. It could still be a turn right now, but the susceptibility to another massive sell-off is still fairly high. It's not like it was back here at the end of or beginning of June, end of May, where we got this nice turn. Most of the charts flipped and switched, and we got a nice rally without a massive sell-off coming into it. Right now there's still that kind of very heavy sell-off risk, associated with the S&P based on the metrics that we see out there. Okay. Now, for the challenge, let's go take a look here real quick at the scans. There's not a new signal on the board, but we are seeing more crossover action. We have FCX, Schlumberger, EWW. I thought Schlumberger was going to trigger here for a little bit. And give us a bearish signal to go after. This is what the stock looks like, and I couldn't argue with anyone buying puts on it. But the consolidation risk on it was just too high. I didn't even get to the point where I took the options seriously, but the options are not very good at all. 194% implied volatility. 194%. You go out one more week, it's 200%. We're just talking about historically high implied volatility. So the option values are just absolute garbage here for Schlumberger. But, the stock, probably, maybe, but the algorithm is not giving a trigger there for it. Same with FCX. The consolidation risk on those is a little bit high. Now, we also have some upside crossovers today, which I find to be interesting. But they're not triggers. J&J, Coke, Procter & Gamble, Verizon. And you'll notice all of these are kind of what you would consider more safety names here. But let's take Johnson & Johnson, for example. It didn't have the crossover yesterday because Monday, well, it just set a really big new low. Verizon, and you'll notice these charts all look the same. They're coming off of brand new lows here. Procter & Gamble, coming off that new low, finally getting its first crossover, outperforming nicely today. I was watching this morning, and I saw it turn and go green, and I texted my brother, and I said, do I dare? And, he texted back, and he goes, yuck. And I said, all right, I'll go for it. But I then looked at the option values and stared at the option values. By that time, the stock jumped another $2, and I just said, forget it. So didn't make the play, but it does have that 3-7 crossover. It's similar to the other 3-7 upside crossovers we've seen on it, in terms of it's not a trend signal. This is so far, more bounce than trend. And then last but not least here, Coca-Cola, which is similar action to the rest of them. Here. So a lot of 3-7 crossovers to the upside this week, and most of them looking like Apple, where got the 3-7 crossover, but more of a coming off of a brand new low than some sort of trend signal. We saw this happen with Netflix last week. I was hoping we'd see a little more pullback in Netflix than we saw on, Tuesday, Wednesday. One of you commented to me that, maybe Netflix is in trouble because the market was up big Tuesday and Wednesday and Netflix went down. And I just responded with a question mark. Why, you can't really say stuff like that in this market. We see Netflix snapping on back. I still like Netflix a lot. The options here, it doesn't have a signal, but the options are starting to improve. The spreads are not ridiculous. They're still high for Netflix, but they're not ridiculous. The implied volatility is at 60, which is significantly better than a lot of other stocks. Schlumberger, for example, at 200. But not a signal for the challenges. We don't have a fresh crossover here on it. We do need to see a little pullback, for that to happen. But we do see this stock holding up phenomenally better than many others in the during the month, and that does have significance. The 1 day stuff in this market, worthless, but the entirety stuff, when you look and say, well, how's this stock performing over the last month relative to the market? Yes, there's some significance there. And as people start to come back to the market, and it's not just fund allocations or short squeezes, it will be something where these are the types of stocks that will get bought up, fairly aggressively. They're not going to go up big on the short squeeze days because they're not heavily shorted to the same degree, and the shorts aren't jumping out of these to the same degree as they are in American Airlines or a Royal Caribbean, right? And, one way that it's a short squeeze on Royal Caribbean is just the fact that, boom, big shot up. Now, okay, the shorts stop covering, and it's a big vacuum down. So you're going to see just massive movement here throughout the stock. If we go through the watch list, and I went through the entirety of the watch list here today, just kind of scanning through it, most stocks look about the same. They're all kind of this American Airline, Apple type of thing, and they're not going to give a trigger tomorrow. Could they give a downside trigger on Monday? They could, but so far, that's not the case. We've had the first upside crossover, so we know some things can happen now, but so far, it's not. And most stocks are in a very similar position. Your Amazons and everything else here. And if you just go look at Amazon and when it had the crossover and what the options were when it had the crossover, the options are depleting, and it's pretty depressing if you bought it, to see the Amazon options depleting the way they are. Boeing having one of its worst days, down 10%. I mean, this is an awful day for Boeing. Any other time period, Boeing down 10%, it's massive headline. Today, you can't even tell it's moving by looking at the chart. Pretty incredible. But, as we go through the entirety of the watch list, most stocks look that way. But there are two stocks that are a little bit different. One of them is Walmart. And, this had the nice 3-7 crossover right back here. Has been pulling back since. And if it does stabilize here around 110 and start to move higher, that next 3-7 crossover is very likely to be a bullish signal that we can go after for the challenge. The options aren't super cheap, but they're not as ridiculous as many things out there. And the other one is Walgreens with a similar concept, a little bit of a higher low here. We get a 3-7 crossover come in. We may be looking at a signal. The 20-day moving average is still falling a little bit, so the consolidation risk may be a little high, but Walmart, Walgreens, decent potential of triggering here as early as Monday. And so we are finally starting to see some stuff that could trigger, here based on what happens in the next day or two. They don't need more of a process. Something like an Apple, for instance, if it has a downside 3-7 crossover on it Monday, we could see it trigger bearish. And there's just a lot of those out there. So hopefully that puts us in a position to be making some trades here soon. I don't know how many of you feel, but I hate sitting on my hands like this. It's not easy. It's not fun. I want to be in. I want to be going. And while I haven't sat on my hands personally, from a challenge standpoint, and we've talked about it, I'm going to stick with the algorithm in terms of all the entries, and stick with the market vibe. And the market vibe is still neutral, and no new entries here for the challenge. But hopefully that shifts here, sooner than later. I hope and pray that you and your families are doing well, and managing along through this historic time period. And just wish you a great weekend, and we'll talk to you again on Monday. Take care.